Well, thank you everyone for joining. Once again, if you just signed on, my name is Ollie Ben. I'm the Director of Philanthropy and Social Impact for the Jewish Community Foundation. We'll be beginning our program now, and I'd be remiss at the end of the year not to quickly mention that we are here for all of your end of year giving needs. We are, as you likely know, we are here and available to help you open funds at the end of the year. We can do that electronically very quickly. We have a very low minimum to start a fund. There are some deadlines you'll want to keep in mind if you are interested in opening a fund or frankly in stocking up your fund before the end of the year. And additionally, we offer a variety of different philanthropic vehicles for you to be able to set up. And we can walk you through, for instance, why a donor advised fund is actually more private than a private foundation, and can offer you significantly more flexibility. Myself and the rest of our team are here to help, so please feel free to reach out with any questions you might have. Now, as we get this program started, we'd actually love to take a quick poll to learn what you are particularly interested in learning about today, so that we can tailor the presentation to what you're interested in. So this question will appear on your screen, and feel free to let us know what you are most interested in learning about today. So the choices are tax planning for 2020, tax planning for future years, Roth conversions, philanthropic planning, updating your estate plans, and including multiple generations in estate conversations. And I'm very grateful I can see people busily filling this form out. I'm going to give you guys just another 30 seconds to do so, because the responses are coming on in strong. So thank you. Okay, I'm just going to give another 10 seconds because I see they are still coming in. Don't miss your opportunity to have a say. Okay, I'm now going to close this out and I'll put up on the screen so everyone can see the results. Share results. So hopefully you guys can see that. Great, thank you. So people are interested in tax planning and updating their estate plans in about equal measure. But there is interest in all of the topics across the board. So I'm glad we'll be covering all of these topics today, but that should give you guys a guide. Thank you everyone for their contributions. Okay, so I'd love to briefly introduce our speakers, starting with Cheryl Rolling. In 1979, Cheryl founded the financial planning firm Rolling and Associates. She's a CPA and a personal financial specialist. Cheryl has been named one of the nation's top 250 financial advisors by Worth magazine and has been included as one of Accounting Today's top 100 most influential people in accounting. A believer in giving back to the community, Cheryl has served on numerous community boards, including Jewish Family Service and the Jewish Community Foundation. Daniel is an estate planning attorney located in San Diego. He's also a California board certified specialist in estate planning, trust, and probate law, and also has a Master of Laws in taxation. Daniel handles all aspects of estate planning, probate, and philanthropic planning. He is part of a mother-son attorney team who has already helped several generations of the family, and he will continue to assist the next generations. Both Daniel and Cheryl are graduates of our Trusted Charitable Advisors program at the Jewish Community Foundation. And just in case you were wondering, the TCA program is an increasingly growing program which has an amazing network of financial planners, lawyers, accountants, and people involved in all manner of estate, trust, and financial planning. If you happen to be interested in signing up for this program, or you know a financial advisor who you would recommend to this program, please feel free to reach out to Charlene, whose contact information is on the screen. We are very grateful to Daniel and to Cheryl for their partnership and for their support, and know that clients working with either of that, and we know the clients who are working with either of them, and always feel like they're treated as family by Daniel and by Cheryl, which is a value we hold dear here at the Jewish Community Foundation. Moderating the panel is our own Charlene Wallach, Chief Impact Officer for the Jewish Community Foundation. Charlene joined the foundation in 2009 and wears an incredible number of hats. She supports strategic planning and oversight, directs our Endowment Leadership Institute, ELI, in partnership with Jewish agencies, day schools, and synagogues, our Governance Leadership Institute, GLI, which educates community organizations about best practices in board governance. That's a tongue twister. As well as leading the Trusted Charitable Advisors and Professional Advisors program we just talked about. So I would love to turn it over to Charlene, who will take it from here.
Thank you very much, Ali, and everybody. That's Oli Ben, our Director of Philanthropy and Social Impact, who's our key coordinator with all of our donor services. So we appreciate his involvement. First of all, a special thank you from me personally. I know a lot of the people on the call today personally, and the fact that you've joined us for this session because you know that Cheryl and Daniel are going to share some special hints with you today is just testament to their reputation in the community. So thank you very much. In order to keep this moving along and in the interest of time, we're going to start with Cheryl. And to start the conversation, I'm going to share, Cheryl, if you can, you know, I'm thinking that the rules and laws of financial and tax planning seem to change every year, and they're always complex, and they always require for best practice to have a professional help us do those plans. What are the best tips and tricks and ideas that you have for us to think about now in 2020 as we navigate the end of the year with a whole bunch of new laws and changes? So Cheryl, take it away. And just a reminder to the audience, if you have questions during the course of the program, please feel free to put them in the Q&A button at the bottom of your Zoom window, and we will try to navigate through those through the course of the program. And if we don't get to them, we will have them answered independently at the end. So just a reminder to please use that Q&A feature. So Cheryl, what should we do this year?
Well, Charlene, thank you for that introduction. There's actually a lot that there's still time to do this year. And let me get my presentation up. There we go. Yeah, we're in kind of a strange time. And boy, that's putting it mildly for this year. But we're going to talk about some things that we can do before the end of the year. One of the things we know is that we have really low tax rates right now, but we don't know what the future is going to hold. So how do we address that? Well, there's some standard planning that we can always do. And then I call it reactionary planning, because we know that we have low rates now, we're not sure what the future is going to hold, that there might be some things we want to jump on this year while we can. And with all of that, there's no one size fits all. It's very individualized. So when you're listening to me talk, try to think of in terms of how does this apply to you, because there's a different answer for everybody. And the answer for one person can be very right and be different for somebody else. So let's talk about Biden's tax proposals. And I'm only going to cover the main areas, knowing that what we have in terms of information is not incredibly detailed, but it's all aimed at raising taxes, and specifically raising taxes on those that make over $400,000 a year. Biden has pledged to not raise taxes on anyone that makes up to $400,000 a year. So what does it mean? Well, one thing they're talking about is having Social Security kick in on wages over $400,000. Right now, Social Security only applies to wages up to $137,700, and then there's no more Social Security tax. Well, Biden is proposing that, okay, you don't have to pay Social Security between $137,700 and $400, but after that, if you have wages above $400, you're still going to pay Social Security. That's kind of a big deal, and I think it has a decent chance of passing because, as we all know, we need to shore up our Social Security funds. Tax rates, the maximum individual rate, he's talking about bringing it back up to 39.6%, and that's up from the current top rate of 37%. Capital gains, this is a big deal. If your taxable income is over $1 million, then capital gains will be taxed at ordinary rates. That means that between federal and California and the surtax, capital gains could be taxed at more than 50%. So that is a big deal. It also, Biden is saying they want to eliminate like-kind exchanges. And for itemized deductions, again, they're going to reduce the value of your itemized deductions to the extent that your income is greater than $400,000. And the value of those deductions are capped at 28%. So even if you're in the 39.6% bracket, itemized deductions can only benefit you up to 28%. So those are kind of the big items that Biden has in store. But the question is, will it pass? If it's a Republican Senate, I don't think much is going to pass. If it's a Democratic Senate, or even 50-50 because Harris would break the tie, then I think you'll see a lot passing. So the elections in Georgia are going to be very important. So the basic strategy that I think we need to keep in mind is that the tax rates are at historical lows right now. And we know that Biden is looking at raising taxes on people with income of over $400,000. So that means we should make moves this year before the tax rates increase. So we talk about some standard planning ideas. And the first one is Roth conversion. And I noticed on the poll that didn't get a whole bunch of votes. And that could be because people aren't familiar with what this is. I'm sure everybody's pretty familiar with what an IRA is, an IRA account. And IRA accounts, you put money in, you get a deduction, you put it in, and then down the road when you take it out, you pay tax. But with a Roth, you don't pay tax on the principal or growth ever again. And you can convert your IRAs to Roth, but you have to tax on the balance. Well, maybe that's not a bad deal, especially knowing we have low tax. I mean, if you could convert your IRAs this year and never have to pay taxes on it again, not even on the growth in the future, that's a great deal. And for most people, there are different phases of that strategy. If you're in a zero tax bracket or a very low tax bracket, then converting Roth is essential. You're just throwing away an opportunity if you don't do that when you're paying very little in taxes. For this year, you're not required to take required minimum distributions. And so maybe consider, instead of just leaving the money sit there, to take the equivalent of the required minimum distribution and convert it to Roth. Now, there are a lot of people that are looking at maximizing their Roth conversions, even though it's going to put them into higher tax rates. Why is that a good idea? Well, number one, I don't think tax rates are going to get lower. So if you can bite the bullet now and not have to pay tax later at higher rates, that's a good deal. And so looking at Roth conversions is a very important planning tool for this year, especially because the tax rates are low. Itemizing deductions, if you take the standard deduction and you're pretty close to itemizing, there's a practice called bunching deductions. And what that means is you kind of push more deductions every other year so that you can itemize every other year and take the standard deduction every other year. So if you're itemizing in 2020, go ahead and claim all those itemized deductions. If you're going to be taking the standard deduction, then try to push off those deductions, additional deductions to next year when you might be able to get value for them. State taxes and property taxes are only deductible to a total of $10,000. So if you've already paid in $10,000 between state taxes and property taxes, do not prepay your property taxes. It makes no sense to prepay them if you're not going to get a tax benefit. And contributions are going to be really important this year because the more you can generate in contributions, the more you can convert in Roth at low tax dollars. And finally, for your investments, you want to make sure that they're being managed tax efficiently. And that's something I'm not going to get into in great detail, but know that you can really manage your investments to keep the tax bite as low as possible. So I said contributions are going to be really important. Normal kind of contributions, we look at a cash, a check, or a credit card, and it's deductible. You make a contribution, you get a deduction. It's paid from after-tax dollars. You can also give non-cash. You can give clothing and furniture. You can give of your own time. Those are deductible to the extent you have costs involved. But you can supercharge your contribution deductions by using appreciated securities. If instead of giving a check, you give an appreciated share of stock, you get a deduction at fair market value and you don't pay tax on the gain. Now, it really is kind of difficult to give shares of stock to the Girl Scouts and your synagogue and, to all the various organizations that you support. That's where the donor advised fund comes in handy, is you can stick a bunch of appreciated stock into your donor advised fund. It's deductible as soon as you put the funds in there, and you can use that money to grant out and support the organizations you want over your own timetable. So the limitations, there are limitations to how much you can give away. And when you are donating appreciated shares, you can only offset up to 30% of your adjusted gross income. Now, if you're going to give direct cash contributions for 2020, you can offset up to 100% of your adjusted gross income. So again, 2020 is a very different year. It's the potentially last year of low tax rates, and you can conceivably offset up to 100% of your income with donations. If you don't itemize deductions, you can deduct up to $300 of charity for 2020 only. And if you're over age 70 and a half, you can give up to $100,000 a year by directly sending money from your IRA. And if you do that, it is not included in income. So it's a way to get a benefit for making charitable contributions, even if you don't itemize. So how does it work if we coordinate it? You can put up to 30% of AGI using appreciated securities into your donor advised fund. And beyond that, up to an additional 70%, if it's a cash donation, can go directly to charities. And so what I look at, if you look at your portfolio, the stuff that's really highly appreciated, that's what you give to your donor advised fund. And to the extent you have positions that are at a loss or haven't highly appreciated, you can sell those first and then give cash to charity. So it's kind of a priority thing where you want to take advantage of that 30% to the extent you can. And then whatever donations you want to give beyond that, that can offset income up to 100% this year. So Roth conversions, it's a golden opportunity this year. You convert the IRAs to Roth, you're going to pay tax at ordinary rates. You give to charity, that's going to offset gains from the Roth conversion. You benefit the charity, and you get a big benefit for yourself down the road in that you have no required minimum distributions on the Roth, and you get to go tax-free on all the future growth. So it's a pretty good deal. Other tidbits. As I said, the future rates on capital gains could be over 50%. Does that mean you should accelerate large gains this year? Possibly. Or you should take the appreciated whatever and give it to charity so that you bring your income down below $1 million in the future. But you definitely want to plan for the future. You want to watch your future income to avoid those rate increases. And the qualified charitable donations can lower your income. Other proposals that are in there are a $15,000 first-time home buyer credit. A 401k deductions would no longer be a deduction. It would be a credit against your income, which is not a good deal because that means your AGI will be higher. And the corporate tax rate goes back to 28% from 21%. So putting it all together, this is what you need to do. If you're itemizing, remember that you can only deduct up to $10,000 in state and property taxes. If you're itemizing, you want to accelerate your deductions, which includes charity and mortgage interest. You should consider Roth conversion, realizing that there's a high probability tax rates will increase in the future, and consider the max 100% charitable contribution deduction that can offset Roth conversions. And if you have a large capital gain, you're selling a business and you're getting paid over time, if you're going to be hit by potentially more than 50% tax on capital gains, you might want to consider electing out of installment sale and extending the return until the last minute possible to see which way you want to go. For all these things, it obviously means you should be working with a professional to help you with this. It's complicated stuff, but if you do it right, you can save a whole bunch of money and benefit charity at the same time. So just remember that tax rates are heading up. Even for taxpayers with income of less than 400,000, we do think the rates will eventually increase. Some rules apply to everyone, bunching deductions, Roth conversions, and basically plan. And with that, I will turn it over to Charlene and Daniel.
Thank you, Cheryl. Whew, that was a lot to absorb, and Cheryl was really kind enough to squeeze this into 20 minutes for us when I know she would feel much more comfortable sharing the information over a longer period of time. But just so everybody knows, these slides will be available to everybody with our follow-up message, along with a recording of today's program. So thank you, Cheryl. I do have a question or two that has come up. But I think what we'll do currently is keep moving along, listen to Daniel's presentation. Some of the questions might actually be answered by Daniel, and then we'll come back to a general round of Q&A at the end of Daniel's presentation. So once again, Daniel, thank you so much for being with us today. We know that you are well known also in our community. And of course, estate planning always has this sort of scary connotation to those of us who have done it, and even scarier to those of us who haven't done it yet. So I'd love for you to share with us some of the ways that we can get involved in our current estate planning. How can we involve the next generation, which is something we all want to consider doing these days? And also, how complex is it? Should we be that fearful of making our plan, and how do we include charity in that process? So thank you, Daniel, for sharing your wisdom with us, and we will continue to collect the questions until at the end of your section. Thank you.
Okay. Well, thank you very much for having me, and let's get this going. Yeah, so again, thanks, Charlene, for inviting me to this presentation. And I thought it would be great to touch on, estate planning and really tying in the theme of engaging the next generation. So that's in a way what we're tasked with in setting up estate plans, is working with our client, eventually with the anticipation of transferring the wealth to the next generation. And hopefully, these are all going to be some timely topics that we'll discuss. And Charlene, like you were saying, should it be complicated? Can it be simplified? Really, that's the role, I think, of an advisor, is to walk, the client through all the different decisions and what to think about and the pros and cons. And so we try to make the process as simple as possible. So, first thing to touch on, might as well talk about it. We're in a pandemic right now. And I wanted to think about what are some of the trends we're seeing with people. Initially, when there was the big shutdown here in San Diego, we sent out a checklist to all of our clients and saying, hey, you know what, you're at home, you have a lot of time, maybe you're getting a little bored. Here's a checklist of things to go over with your current estate plan. And so one of the biggest kind of issues we realize with people is, do you know where your documents are? And so that's always very important that, just like in a disaster drill, you don't know if you have a good plan or not until you try to reenact it. And in this case, we're hoping that people, have sort of a plan. Do they have, copies of their documents? Does their family know where the documents are if they need to find them? And so now is a good time to, get that all together. Another big, item on the checklist is always, who is the successor trustee? So who's the person that's going to be tasked with handling all of your financial affairs if you're unable to do it for yourself? And so, we always recommend people, review these things every couple of years, maybe 3 to 5 years. Of course, not everyone does that, and you end up doing every maybe 5 to 10 years. But are the people that you've named in there still, the right people for the job? And now's as good a time as any to maybe reach out and talk to them and say, I've still named you, and it's been a long time since we talked about this, and does this plan still going to work? And of course, in dealing with sort of a medical emergency, as part of everyone's estate plan, you should have an advanced healthcare directive, at least here in California. And so that's the document that says, if you can no longer make a medical decision for yourself, who can make that decision for you? And of course, that's going to be on top of mind for so many people these days. And at a bare minimum, the healthcare directive is just there to name somebody to make a decision for you. So if you're unconscious or you're recovering from surgery or there's a decision that has to be made, the doctors need to know who to talk to. And of course, you can add as much information into the healthcare directive, or even to go along with the healthcare directive, to be very specific about what your exact wishes are. And so a new thing that people are bringing up is the idea about being on a ventilator. It's kind of a new issue that people are being faced with. And so that's something that you can express your wishes on. So I feel like a lot of us probably could have gotten a medical degree during this pandemic with all the research that we're doing. So if you have strong wishes, it's important for you to convey that to the people in your healthcare directive. And you could either do that by telling them, by writing it down, But it's something that, if it needs to be looked at, somebody needs to know how to follow your directions. And of course, another trend that we've actually changed in our own documents was what happens if you're in the position of maybe losing capacity, but regaining capacity. So not just medically, but also financially. What's the process for kind of going back and forth? And it used to be, people are more focused on the idea of, once you lose it, you lose it. There's not a big chance of regaining capacity in the most part. But of course, nowadays, what if you are, I don't know, locked up in quarantine or in the hospital, for an extended period of time with the, the assumption that you're going to be back on your feet at some point. During that whole in-between period, do the documents, would they come to life so that somebody can continue to handle your finances until you get it back yourself? And so if something you haven't reviewed your documents in a long time, you can reach out to your estate planning attorney to see, how would this work? Does it take the doctor's letters that people are familiar with and getting to declare me incapacitated? And then how do I regain capacity? Is it just a statement on my own? Does it take another doctor? How would that work? And again, in dealing with the next generation, and this is something, as I think Ollie mentioned, that I am the son of an estate planning attorney and we work together. And I remember when I turned 18 that mom had me sign a bunch of these documents. And one of them was the Advanced Healthcare Directive. And the reason is, in California, when you're 18, you're an adult. So of course, from a parent to a minor, the parent can make all the medical decisions and talk to the doctors and get information about that. But once the child turns 18, the parent no longer has the ability to get that information. So if a child's going off to college or, maybe just living out on their own, if something were to happen to them and there's no healthcare directive in place, the parent, technically, the doctors couldn't talk to the mom or the dad. They couldn't make any decisions on their behalf. And so it's really important in getting these healthcare directives set up, even if you have there's not a formal estate plan in place, that you have the healthcare directive. And I even put a link for the form, since the slides will be sent out, for our California statutory forms. So these are forms meant to be available to the public, where they have instructions and you don't necessarily need to have an attorney, advise you. It couldn't hurt, but we give these out to our clients when they have children that are adults, but aren't ready to do their own estate plan. And of course, also a power of attorney. So on the financial side of things, kind of another easy estate planning document to take a look at for yourself could be a power of attorney for finances as well. Oh gosh, and then to some recent developments, and it's not necessarily sort of end of year developments. This actually came up or starting this year, and it has to do with changes on inheriting a retirement plan. So the Secure Act was passed, and it says, the old law used to be that anytime, let's say, a parent named a child as the beneficiary of a retirement plan, that when the child received it, they could stretch out the retirement plan for their lifetime. So that was called by setting up an inherited IRA and doing a stretch. And so that meant that, let's say a parent died, left a retirement plan to the child could keep the retirement plan in existence and only take out small distributions every year. Immediately after the year after the parent's death, they take a small amount out every year, and it could grow, tax deferred for the rest of the child's life, or like Cheryl said, if it's a Roth, tax free, which was great. But starting this year, the law changed, so now any person who passes away after January 1st of this year, naming somebody as a beneficiary of a retirement plan, unless they are excluded in that list right there, they have only 10 years to withdraw the entire IRA and pay all the taxes within that 10-year period. So again, surviving spouses, you're still fine. But if you do have, kind of the next level, saying it goes to your children or grandchildren or anyone else, they will have to completely withdraw the entire IRA within 10 years after the date of your death. And so this is going to be a huge shift in estate planning. So we used to always tell clients, go ahead and just name the kids, they get the stretch out, nice and simple. But now with the kind of the death of the stretch IRA, it's not going to be as simple anymore. And it can have a huge tax effect on that next generation when they eventually inherit the funds. And so one solution potentially that we bring up with people is if you want to mirror the effects of a stretch IRA, instead of that 10-year withdrawal period, you could have the IRA payable into what's called a charitable remainder trust. So that would be a trust that you set up with your estate planning attorney. And it's just this empty bucket that exists. Upon your death, the IRA goes into the trust. And now the trust provides that the distributions come out to the child, in this example, for the rest of their life. So it doesn't have to be the 10-year withdrawal period. And it's kind of a technique to sort of match the stretch and also get quite a bit of money to a charity. And so I won't go into the mechanics of it, but for certain clients that want to give to charity and are also maybe worried about the tax implications of a retirement plan going to a child, this is definitely a technique that we bring up with them. And then just as another takeaway, if you're looking for something to do and it's free, you need to check the beneficiaries of your retirement plans. And if you haven't updated them or looked at them, really this year, and if you have it payable to a trust or kind of any version of maybe spouse and grandchildren and children and everything, now's a good time to review that and check with your estate planning attorney if that's still the way it should be. Another topic, again, we just came off of an election. In a way, it's not completely decided because we still have that Georgia runoff in January. But what are some of the potential estate tax changes that are kind of out there? Cheryl went over more of the income side, but on the estate planning side, we looked more at estate taxes, which is also called the death tax. And so the current amount you can have in your estate without paying a tax at your death is about $11.5 million per person. Between a married couple, you can combine that, so you have more than like $23 million that can pass free of estate taxes. And with that exemption being so high, it covers many people that they don't have to do estate tax planning with us because they'll never have an estate tax issue. But that $11.5 million is actually set to revert to about $6 or $6.5 million at the end of 2025. So with the Tax Cuts and Jobs Act that was passed a couple of years ago, those laws are set to expire, and that included the estate tax exemption being so high. And so that's what we know for sure, that the law is going to change at the end of 2025. However, there could always be an act of Congress and presidency and change in legislation to even lower the exemption before that date. And so what's been proposed, or kind of what's on the wish list, is to lower the exemption amount to what it was in 2009, which was $3.5 million per person. So with a 45% tax on the amount over that amount. And so that would have a huge implication, the swing from a married couple being able to exclude $23 million down to only $7 million, only $7 million. It covers a lot more people that would have to do estate tax planning. And another potential thing that's been brought up is repealing a stepped up basis at death. So under the current law, all of your assets that you own receive a new income tax basis upon your death, other than retirement plans and annuities. So in a simple example, you buy Apple stock for maybe $10 a share, and if it appreciates to $100 per share and you sell it, you pay the tax on that gain. Instead of selling that stock, if you own it at the time of your death, the cost basis gets adjusted to be equal to the value on the date of death. And so let's say your heirs, immediately liquidate everything the day after your death, they're not paying any taxes because there's no gain. The sale was worth, or the cost basis was sold at the same amount. And so again, another potential issue or change in legislation that we would come up, or that we're looking out for, is whether or not they would actually repeal the stepped up basis. And so that would also have a huge effect. And sort of the big concern is we're closer towards the end of December almost already. And of course, none of this law is really even on the table to be looked at right now. And so worst case scenario is, what if the law gets changed at some point in 2021, but they make those laws retroactive to January 1st, 2021. And now it's too late to do any planning. So that's what some people are concerned with. And so we're saying, talk to your estate planning attorney to see if you need to do any potential estate tax planning with the potential change in the exemption coming up. Oh gosh, property taxes. So hopefully I'm not the bearer of bad news here for anyone that owns California real estate. But in addition to the federal election, we had a statewide election. with Prop 19 being one of the propositions that passed. And this, if it's unfamiliar to you, you may have voted on it without knowing, but this was the proposition that allowed people 55 and older to change residences and keep their same property tax bill, whether they sell, their house or buy another house for a higher or lower amount, any county in California. And it also mentioned that, any income generated from this proposition would go to victims of wildfire disasters and create a fund for all of that. But if you kept on reading a little bit more into the proposition, it also changed sort of fundamentally what many people refer to as Prop 13. And so that has to do with property taxes at death. So under the old law, property taxes when a property passes from a parent to a child can pass without being reassessed for property taxes if they're transferring the principal residence in an unlimited amount, plus $1 million of assessed value of other property. So in a simple situation, let's say the parent owns their house. Maybe it's a nice house out in La Jolla, it's worth a couple million, but they bought it so long ago, the assessed value on the property taxes is only $300,000. So they're paying a nice low property tax bill on their really expensive house. So they have their La Jolla home, and maybe like a rental property that maybe was their first home that now they rent out. If under the old law, if the parent died and left all of those real estate properties to their children, the children could take the La Jolla home, the rental property, and do whatever they want with it and keep the same property tax bill for each of those properties. And so that was sort of one nice thing we got to tell children when we represent the trustees in administering a trust, that, hey, you get this nice low property tax bill that's coming from a parent to a child. However, starting February 16th of this next year, all of that's going to change. And so any transfer that occurs after that date, the only time you get the parent-child exclusion, so the only time that property taxes will not go up, is if the parent's principal residence transfers to a child and they in turn make that their principal residence. So the child has to live there and make it their principal residence, and that's the only time that the property tax bill will stay the same. And not only that, the amount that does not get excluded from reassessment is only $1 million above the assessed value. So in that example where I mentioned the La Jolla home, so let's say the parent purchased it for $300,000, it's worth $1 million. In that case, the parent dies, leaves to a child. If the child lives there, they can keep the same property tax bill because it's within that $1 million amount. Let's say the property is worth $2 million. So now you have all of this, appreciation that hasn't been taxed for property tax purposes. The first million above the 300,000 is excluded, and now you have another $700,000 above that will be included in the assessed value for property tax purposes. So even in the situation where the parent leaves their primary residence to a child and the child lives there, property taxes could still go up. And again, property taxes are paid every single year. So the longer they hold on to it, kind of the bigger magnification effect that Prop 19 has on those situations. So here's just a visual example. So, kind of using lower numbers. In this situation, mom buys a house for $200,000. Now she pays about $3,000 per year. If the property is worth $800,000 at the time of her death, and then the Prop 19, disqualifies the child from keeping the low property tax bill, the child or children, if they keep, multiple children, end up paying $50,000 more in property taxes over a 10-year period. So it has quite a big effect. And that's another situation. Let's say it's a rental property. And so in any event, no matter what, the rental property is going to be reassessed for property tax purposes in the future because it wasn't the parent's primary residence. So in that situation, using similar numbers, children could end up paying $70,000 more in property taxes per year. And there's many people, in Southern California that they have, quite a few properties, and not just their home and a rental property, but maybe several rental properties or commercial building. Even this will affect commercial property that passes from parents to children. And so if you're thinking, what should I do before the end of the year? Bring it up with your estate planning attorney that you heard this presentation about Prop 19, and is there anything that you should be doing about it now? And if anything, They'll ask you for your property tax bill and maybe your cost basis of the property, and try to crunch the numbers. So that's what we're doing in our firm, is we're getting sort of 2 or 3 meetings a day about Prop 19 and how does it affect people. And we're trying to, right now, just crunch the numbers and then see what planning options would be available before that February deadline. Okay, so again, thank you, Charlene and Ollie, for inviting me. And if we have time for questions, I can stay as long as you like.
Yes, please. And thank you, Daniel, again. I know it's hard to crunch this amount of information into a small window of time that we were given today, but you've done a fantastic job. Once again, all of the slides and the recording will be available to our attendees. So if you've missed something and you want to talk about it with a family member, you'll be able to do so. Now, we will move on to some questions, but before I do so, I just want to remind all of you listening today that the JCF staff are also here to support you, to answer your questions, and to help navigate your current needs or your funding opportunities, both now and in the future. And as a reminder, we offer complimentary consulting for grant making. So whether you want to hook up with an area of interest that you have, or you're really not sure what the community needs are right now, we would like to help you with that. And you can contact Ollie or one of our team or myself. I also want to remind you that this moment that we call estate planning or legacy planning is something that we're working on with donors all the time at this moment. You do not need to have a donor advised fund with us to engage in a complimentary consultation. And then we work in concert with your professional advisor to make sure your intentions are documented well and that we honor your lifetime of giving. So with that, I have several questions, both for Daniel and for Cheryl. And Daniel, I'm just going to tag on, since you just talked about this notion of taking this opportunity to brush off the dust from old trusts that we have packed away somewhere. But you also talked about multi-generational conversations. Would it be something important or advisable to educate our successor trustees about the estate plan, or is that sort of like the best kept secret until after they pass?
Yeah, so we always get that question from clients, and of course it's going to be up to them. And the thinking would be, one, you could always change it. So you could always change your mind in the future. However, we do say, maybe if you do want to bring in the successor into a meeting with us, and we would sort of go through maybe some of the initial steps of what it takes, in settling an estate. And part of it also is just educating the client and thinking who would be the right person for the job. We have to sort of describe the job to them. And so, right, people are sometimes concerned about the idea of speaking about money with their family. And we don't necessarily have to get into like values of anything, or, maybe what I expect you to do with your inherited money, but it could just be, this is the task that a successor trustee would be dealing with. So we talk about, what if it's something that happens in your lifetime? So you become incapacitated. Do they know where the documents are? Do they know where your accounts are? Can they keep the business of you going? So pay your bills, file your taxes, deal with the financial advisor, all of these things that could come up. And yeah, I would say, the clients that really have sort of the tight-knit family are the ones that do take us up on that opportunity, because they're less concerned things could be, changed in the future. But we also offer, probably webinars now in the future about a job of a trustee and what are the potential conflicts and duties and liabilities. And so sometimes, yeah, our clients will just have their kids watch that.
That's great. Thank you. Thank you for that. Cheryl, moving on to some financial and tax questions. The first one, which pretty simple, I think, to answer briefly, and then I'll go to a second one, is the 400,000 income that you talked about. Is that per person or per household?
That's a good question. The answer to that is we don't know, because when we look at Biden's proposals, he talks about 400,000. We don't know if he's talking about adjusted gross income or taxable income. We don't know if it's for a married couple or single. We just don't know. The Social Security tax coming in on income over 400, that would be wages or self-employment income over 400,000, and that would be per individual.
Okay, thank you. And then shifting our focus for a minute to IRAs and this notion of Roth conversions, a two-part question. Number one, is there a maximum amount that one can convert from an IRA to a Roth? And is there a minimum age one needs to be in order to do this process of converting to a Roth?
Well, the good news is there's no age limit and there's no dollar limit. And, you know, I literally have had clients who convert millions of dollars of IRA to Roth, even though it's a tax hit now, to have never pay tax on that again, not on the growth, and not have to take required minimum distributions. It's a really good deal. But whether you convert 10,000 because that's what gets you to a break even tax this year, or 100,000 or $1 million, whatever's right for you, this is a great year to be looking at Roth conversion, especially when you can get more deductions for charitable contributions at the same time.
Yeah, that's what I was wondering, is that the one can somewhat offset the other, right? So the additional taxes for the conversion, and then some charitable planning, that especially if it's done in a way using appreciated assets where you're sort of double dipping and not paying the capital gains and still getting the tax receipt in this year, could really be beneficial in the example you used before with bunching.
Absolutely.
This time to do that. Great, very good, very good. And is there still time to do all this, or is it like too little too late? Or now we're in the first week of December, do we still have time to do all of this year?
There's still time. I mean, to do a Roth conversion, sometimes the issue is that the client doesn't have a Roth account. So we have to open up a Roth account so that money can flow from the IRA into a Roth. And in terms of the charitable contributions, you know, you guys are great about being able to set up a donor advised fund like that. And like you said, to transfer appreciated securities, you have until December 24th. So there is time. There's not so much time that you can decide, I'll think about it in a couple weeks, but this would be the opportunity to look into it.
Great, thank you. And Daniel, as long as we have another moment, if someone's interested in philanthropic giving, if somebody says, oh, I haven't included that in my estate before, but that sounds like a really cool idea, do you do that? Do they have to come and have a special meeting? How does that work, and how can they get started?
Yeah, so actually kind of including charities in estate plans is pretty easy to do. And I think many people like the idea that they can do it, and sometimes it's on the estate planner to even bring it up as an option. And so sometimes just the fact, you know, we'll ask a client, you know, did you want to include a charity in your estate plan? And it could be a simple bequest of, you know, $5,000 to the Humane Society or something. And then we just kind of let that, you know, write that in. It comes off the top, and I think people really enjoy that. And sometimes we'll even ask them, you know, do you give, you know, in your lifetime? Are there any charities that you support in your lifetime? And would you like to do that in your estate plan as well? And, you know, for some people, it could be kind of a drop in the bucket compared to what is going to maybe their children. And I think charities, you know, really appreciate it, and they can, you know, get quite a bit out of it. Yeah. So it could be as simple as, yeah, just these little bequests. We can always write percentages into the estate plan. So some people are worried, oh, I don't want to, you know, give so much to these charities that, you know, it takes away from the children kind of in the big picture of things. And so we let them know that we could just write it as a percentage of your estate. So if we look at the whole thing on a whole, we just, you know, give maybe a couple percent. Or you can even write a formula. So again, we always go over this different options with the clients. And I think some people sometimes feel they have to come in with all of the answers. And that's not the case. So our whole goal is to act as a guide for them on giving them things to think about and being practical on how to include it, and giving them the opportunity to, that their intent, you know, is carried out in the event of their death.
Thank you. Thank you very much. I know there are other questions that will still come up, and Ali is going to share some of that with us. But once again, thank you, Daniel and Cheryl. And every time I listen to both of you, and I've heard you both many times, I'm still learning, and I'm learning things every time. So thanks for sharing your wisdom and insights today. Ali, I'll hand it off to you.
Great, thank you, Charlene. And thank you so much, Cheryl and Daniel. You're both great friends of the foundation, and we really appreciate your support and your wisdom, so thank you. You may have some questions that you either didn't get answered or that you didn't want to have asked in a more public forum like this. So we wanted to create a mechanism so that you can actually have your questions answered by one of our tax, financial, charitable, or estate planning experts. So you'll see a link that I just put in the chat. And if for any reason that doesn't work for you, you can just type in what's on the screen, tinyurl.com/JCF questions. And that'll take you to a quick form that you can fill out. And on that form, you'll be able to ask your question. We will make sure that Daniel, Cheryl, or one of our other experts gives you a response. So I just wanted to say thank you once again. Thank you for your time. We are always here for you if you have questions. But otherwise, enjoy the rest of your day, and we'll be returning in 2021 with a rebooted version of Access to Insight. We'll be doing some deeper dives into certain specific philanthropic areas, so we're very excited for that. Please stay tuned for that, and have a happy holidays.
Thank you. Happy
All right.
Hanukkah, everybody.
Thank you.